Hello, and welcome to the Startup Lantern. This show is for entrepreneurs, especially if you're trying to do a startup around security. If you've ever thought about doing a technology startup, you may also find this useful, so thank you for tuning in. We hope you can take advantage of some of our hard-earned lessons so that we can make your process of doing a startup as smooth as possible. Throughout this series, we're really excited to share some of our lessons learned. But a quick disclaimer before we begin, we're not attorneys and we don't play attorneys on TV. We do believe that you need to engage legal representation so that you can make sure your financial investments and your intellectual property are thoroughly protected. Hello, I'm Jon Duran, and I've spent many years in the technology sector, with a number of those years being involved in startups. Now I focus my time on helping customers apply technology, and in that current role, I get to spend a lot of time interacting with startup companies.
And hello, my name is Druce McFarland, and I've been on the other side of the fence from Jon. I've done a number of startups throughout my time. Today, our topic is going to be angel investors. So if you're familiar with the entire process, typically people talk about going out and talking to VCs. Sometimes they talk about going to angels. We're going to focus on that early stage, which is typically talking about angel investments and everything that you might need to know in going in if you're trying to start up your organization. What do you need to know about the angels?
So today we're talking about angel investors. And the first question that comes up is just, what are angel investors? Well, angels investors are typically just individuals, not usually businesses, and they're folks who seek to invest at the early stage of startup companies. Their goal is to help you get companies launched. Angel investors tend to provide a more favorable term as compared to maybe the venture capitalist and other lenders out there, since their goal really is to help you get your business off the ground rather than sustain the business over the long term. Angel investors usually have more of a focus on helping startups take those initial steps rather than profiting from the business long term, especially as angel investors would really be essentially the opposite of venture capitalists. Some angel investors even invest through online services and crowdfunding type platforms, and they even work together in many cases to build pools and really have a broader viewpoint of what's happening in that startup market.
So when it comes to angel investors, they're often going to be the people that you go to first. When you're starting off an organization, especially if you're starting a products company, as we've mentioned in the last several episodes, you want to make sure that you have enough money to see yourself through and make sure that you're not worried about where how you're putting bread on the table. You want to make sure that you have everything set together. An angel investor is going to be that early person to come in. They're frequently, trying to operate to a degree like a venture capitalist. They're trying to get in on something. They typically don't have the deep pockets that a VC would end up having. So, when you're going out and you're looking at at getting some sort of institutional funding, and it really depends on the amount that you're looking for. An angel is going to be there for the hundreds of thousands of dollars sometimes, whereas a venture capitalist is not going to be interested in an investment that small. So therein lies the next question, which is, why do we have angel investors to begin with? Angel investors, can help you seed things. Every single round that you ever go through has to be for some sort of a purpose. So sometimes that purpose is to create a prototype, or maybe you've got a prototype and you need to get things to the point where it's functional and it's actually ready for the market, or maybe you're trying to build a sales force. Every round has got some purpose behind it. Angel investments are usually very early in the process, so it's there probably just to get enough of it together that you can actually show a prototype. One of the interesting aspects about them as well is, if you think about angel investors this way, you never want to go to a grocery store hungry. So you want to go there and you want to maybe get a little bit of a snack so that you're not as hungry when you're out there buying. Venture capitalists, are really well aware of the fact that time is on their side when it comes to some of these investments. So the longer that they can draw things out, the hungrier that you're going to be to just accept any deal. An angel, by contrast, is going to go in there. They're going to apply a lot less scrutiny sometimes. They just want to get in on the opportunity and with the same terms that the VC would end up having. So they're going to give you that buffer of cash that you can use so that you're not as pressured by the hard tactics that the VC is ultimately going to give you going in. So an angel is going to be there, to kind of ease the way so that you aren't going to end up making bad decisions because you need cash going into an angel, going into a venture capitalist.
Bruce, but a question that usually comes up, if I have such a great idea and the venture capitalists usually have such a network of helping drive a business, why wouldn't I go straight to a venture capitalist right with that great idea?
Well, you certainly can. A little bit of it depends on how great the idea is and whether or not. Again, with everything, when you've got a startup, everything is ultimately comes down to timing and how quickly can you get to market. Usually if you've identified some sort of really good some sort of a really good problem that you're trying to solve, how long will that problem actually exist out there? So when you go to a VC, the VC, they say that when you have a venture capitalist, everybody knows that they're sharks, but once they've invested in you, they're your sharks. Well, they haven't invested in you yet, so they're really out there to get the best terms. And if they can drag their feet by a month or two, and they just need to dot those I's or cross those T's a little bit longer, you're going to get hungrier and hungrier. If you've gone off and you're doing this full time and you're not seeing a paycheck because there's no, like, all those things are going to influence your decision, and they know that. So having that angel investment is sometimes just good to have that, it's like having that snack before you go into the grocery store. I can go into the grocery store knowing I need to buy X and Y and Z, but if I'm hungry, that cheesecake really looks good, and you don't necessarily want to go down that route. Same thing here. Just having a little bit of a cash buffer going into it, having a longer runway that you have to go in, is just going to take some of that pressure off so you can make the best informed decision when you actually start talking to a VC. So then the next question ends up being, what should you look for in an angel? And really, it comes down to, first and foremost, is it's good to have somebody that's got the cash. Having cash and having done this a few times is good. Having what they call smart money, somebody who can not only provide you with a financial incentive, but also be able to give you some advice and maybe open up some doors is useful. But you're really looking for somebody who can do that, who can come in there, make sure that they're going to be able to make sure that their investment is well spent. So somebody who can do that. When you're dealing with an angel, you're definitely dating here, and you have to make sure when you start talking to that angel, how involved are they going to be, and are you okay with that level of involvement? You may want somebody who just kind of kicks open some doors when you go back and ask for them. You may want somebody who's going to be very hands-on. Those are all differences of approach, and it really depends on what your specific needs are. If you've never done this type of thing before, having an angel who maybe has done this and that's why he's got the cash, it may be good to have his advice in there. But you're basically looking for somebody who's good, who's stable, who's got the money. We're going to be using the term a little bit later that they have to be an accredited investor, which means you can't easily go to just anybody off the street and solicit money from them. And you have to be very careful when you start soliciting money. And we'll talk about that in a little bit. But they have to have a certain amount of net worth so that they don't think that you're trying to steal, grandma's rent check or something like that to invest in your organization. So looking for somebody who might be an accredited investor and looking for somebody with some industry connections, industry value, and good advice. Those are things that you're kind of be looking for in terms of an investor.
Finding angel investors is really not that hard. In many cases, if you're starting up a company, chances are there may even be someone in your family who would meet the criteria to be a financial investor in your organization. But friends and family is a good place to start. If you know of other startup companies that you've worked with, feel free to ask where they found their funding. They may have some great sources that they could share with you. Also, there's a lot of information on the web, a lot of websites where angel investors are creating the pools that we talked about, pools of funding, or maybe even companies that help match angel investors with with organizations. So there's a lot of good info out there. We'll post some of that in the contents. So look below in the contents section for some additional info. And I would say, lastly, a lot of times networking events in the particular industry that you're associated with are great ways to find angel investors. They're really, and you want to find an angel investor that's related and is interested in your particular business segment. And so those networking events usually help you map those connections and make those great connections.
Exactly. And in going to this, and we're going to talk now about actually going out there and asking for money, going out there and pitching. I want to draw attention to the phrase that Jon actually started things off with here, which is we're not lawyers. You really need to talk to a lawyer about some of this stuff, because there are some aspects of going out there and asking for money that can be a little bit sticky. And we'll go into that a little bit here. So none of the stuff I'm getting ready to talk to you about are there, hard, fast rules for some of these things, but some of them, there are laws about it, and you have to make sure that you understand what the legality is before you get too far. So first of all, at what point are you talking to an angel versus what are you, what would you go to asking for a VC? Well, typically, a venture capitalist is going to be less and less interested in you if they can't put a reasonably sized investment in you. So if you're asking for something under 3 million as a startup cost, they're really uninterested at that point. It may sound like, well, I want to make sure that I'm not taking too much money, so I'm not giving that much of the company away, and that's great. Except you're going to turn off a lot of investors. They've got a fund. They've got maybe 100 million, 200 million that they're trying to figure out how to spend, and they don't have the time to be doling out $1 million here, $1 million there. So angels typically operate something less than 3 million, maybe 2 million or whatever. Now, if you what you would end up looking for, that a little bit of it depends on how much you're asking, and you don't have to get all of your investment from a single individual. You don't have to have one person with $1 million. You can have 10 people with $100,000 and get them all in on the process. So you're basically just looking for somebody who can contribute. You have to know how much money that you're ultimately looking for, and that doesn't all have to come out of the same individual. But then going into this, the people that you solicit money from have to be accredited investors. And what that typically means is one of a couple of things. Number one is they have to have a net worth of $1 million or greater, and that's not including their primary residence. So, if they have a net worth of $1 million because their house is worth 1.4, but they have nothing in savings, you're like, they're not a candidate. And, so there's that. They can also, have to, and or they would have an income of greater than $200,000 a year for the previous 2 years, or that can be $300,000 if it's a married couple. So these are people, and these seem a little bit odd. You're like, I don't even want to say odd. They seem a little bit unfair. How's that? That you got these sorts of investments, and people, like everybody would like to get in on that, and it seems to be just reserved for these elites. Unfortunately, these rules are set up so that there aren't any predators out there trying to get somebody's retirement savings. They want to make sure that the people who are taking these risks and doing an investment like this does constitute a larger risk than, say, investing things in the stock market. The upside is the payback for this investment is going to be greater than anything that you'd be able to get in the stock market also. But that's out there to try to protect those people. Now, having said that, the people that you're pitching to have to be accredited investors, which means that you can't go up onto Facebook or onto Twitter or something like that saying, hey, I'm opening up a round. Anybody want to be a venture capitalist? Because you're pitching to the entire world, and you can get absolutely in trouble with the Securities and Exchange Commission. So you have to make sure that the people that you're talking to are accredited. Now, having said that, that doesn't mean that your mom or dad or whatever, there are rules about, you can let friends and family and types of things. You have to show that you've had a number of interactions with them as well. So you can bring smaller people in, but in general, if you're looking for an angel, you're probably, aside from those small things from that might be family oriented, you want to be looking at people who may have a reputation as being an angel, just to avoid some of those things. Again, not a lawyer. Talk to your lawyer. Try to find out what the exact rules and regulations, because these can change from state to state as well. Figure out what the circumstances are around your specific area of investment. So then there's terms and conditions. You're going in there. You have that guy who wants to drop $200,000 in as an investment. How much of your company are you giving up? Well, the the cool thing about the way that this works, and they don't tell you this in a lot of circumstances, is you don't have to make that decision right now. Typically, what an angel is trying to do is the angel is trying to get in on an investment that they typically wouldn't be allowed to get in on. So the way that venture capitalists work is they raise a fund of money from a lot of the financial heavy hitters, people who've cashed out, et cetera. They get to invest in this fund, and then they go out and they spend this. An angel is not going to quite qualify for that level, but he'd still like to get in on that type of action. So what the angel is doing is they're giving you the money, and that is transferable at the terms that are set by the VC themselves. So in other words, they give you the money. You haven't established what the company's worth. You haven't established how much they get for that. All you've established is that if you're taking in 200,000, that 200,000 is transferable at the same rate as as your Series A ends up getting executed. And they'll typically be okay with that because, again, they're not going to get this type of an opportunity, in any other sort of way. They can't act like a VC unless they are a VC, and they can't just call up Kleiner Perkins and say, "Take my money." So they're looking to get that type of assumption without necessarily qualifying in the normal way. So they're also taking advantage of all of the resources that that Series A VC is going to come to play with. So the Series A VC is going to come in there, and they're going to do all the due diligence, and they're going to dig through your business plan, and they're going to dig through your financials, and they're going to go out there and talk to your customers, and they're going to put you through the ringer. And then at the tail end of that, they're going to say, "I think you're worth X. We want to give you Y, and that means that we've got this percentage of the company because we've now established that your price per share is $10. And if it's $10 and that person to begin with had invested 200,000, you do the math and you figure out how many shares they end up getting. You figure out what percentage of the company they end up getting as well. It's all established at that time when the Series A closes, and the angel gets the same terms as the big institutional investor. So that's the cool thing about this, is the fact that you can do all that, and all that legwork that you would normally have to do. You don't have to do that with the angel and then do that again with the VC. You're kind of doing it once with the VC, and they're getting in. Having said that, again, not an attorney. If you choose to bring somebody in, as an angel, and you want to go through the repricing exercise and everything, you're welcome to do that, and it is done that way sometimes. But we just want to let you know that this is frequently how this is done in the tech industry, specifically for like I said, we are our major background is in cybersecurity, and this is definitely how things are being done now around the Silicon Valley area, and how a lot of these high-tech startups end up getting funded.
So, Druce, just to confirm, really at the angel investment stage, you're not assigning and issuing stock. You are taking an investment stake. The stock will come at the point when you move to a venture capitalist and get a Series A funding.
Correct. Yeah, you typically when you at the point in time when you're talking to an angel, you probably have incorporated. You probably do have some sense as to how many outstanding shares that you have, but you are not giving that angel shares yet. You have not established a price of the share, so they don't know how many shares they're getting. They just know that when that gets negotiated with the heavy hitters at the venture capitalist, that they get on some of the action.
Well, in a perfect world, you could take your angel investment money, and as you described earlier, you've had your snack before going to the grocery store. That would be the perfect time to go to a venture capitalist. When you've got funding, you've got a long runway, you know what's going to happen. I think the challenge with that we see is usually the idea of the angel investment is to help ensure that you get your company launched, you get your prototype built, you get your developers on staff, whatever is needed to get that company launched. So there usually is in your business plan a strong need, a financial need for that angel investment funding. And so it's probably not realistic to expect you go get angel investment funding and then turn around and use that to open the door to venture capitalists.
So I hope that you found this to be valuable. Again, there are as many different ways of doing a startup as there are startups out there. This is what we described here is a common way that people end up approaching angel investors, but it's not the only way. Again, because we're now starting to get into some of the terms and conditions and the legals of it. Consult your attorney if you're starting to go with this. But it's really good to have this knowledge in your back pocket so that when you walk in, it doesn't come as a surprise. And when people start talking about this, you know what the options are. Like if you've never done this before, and some angel walks in and says, "Oh, yeah, this is what we do all the time. We give you 200,000, then you give us half the company." You kind of know that that's not necessarily going to end up being the case all the time. So you want some of this information so that you can walk in a little bit better informed. So we hope that you found this entire episode to be valuable. If you have, we invite you to like and subscribe below. We are also, as Jon mentioned, we're trying to build a community here. So we'd really love to hear from you. If you've got a startup, if you're thinking about doing a startup, if you have questions, write to us in the comments below. We'll try to get to all of them as much as we can. We're really interested in hearing from you, and we would like to help you guys be successful in the new year. So again, my name is Druce McFarland, and it's been a pleasure to speak to you.
And I'm Jon Duran. Thanks for attending our episode of the Startup Lantern.